Good afternoon, and thank you all for attending today's program, Practice Transitions That Work. We've got a full house today and a limited amount of time to go over a lot of material, so I will go ahead and jump into our discussion this afternoon. I want to give you a little bit of background about myself so you know who you're listening to today. My name is Peter Ackerman. I have been working in the field of dental practice, brokerage, appraisal, and consulting since 1995. So this is my 26th year working exclusively in practice transitions as it relates to dentistry and the related specialties. I'm located here in the Chicagoland area and work primarily in Northern Illinois, touch upon a little bit of the surrounding states as well, Indiana, Southern Illinois, been into Iowa, Missouri. We do some transition work as well. My background comes from finance. I graduated Miami of Ohio University with degrees in accounting, general business, and finance. Went on to practice as a CPA for all of about 1 year before I determined tax returns and financial statements were a little bit mundane for me and wanted to move on into something a little bit more exciting, and I fell into the career of dental practice valuation and transitions. So I furthered my education and certification by obtaining what's called a CVA, Certified Valuation Analyst. It is a specialist in valuing closely held businesses, which of course dentistry falls into that category with revenues anywhere from 100,000 up to about $50 million a year in revenues. And fairly recently, within the past 5 years, went on and obtained an additional certification, which I found fascinating, which is called a CEPA, Certified Exit Planning Advisor. It's a holistic approach to helping business owners exit the ownership and obtain equity out of the businesses that it may have been in their hands or their family's hands for multi-generations. We're seeing a huge glut of the baby boom generation that not only owns dental practices, but family-held businesses in the United States looking for exit strategies. So it looks at not only just the financial piece, but also looks at the emotional piece that's involved, finding the right successor, getting the right match, looking at your family situation, whether you have multi-generations that will follow you, whether there's living trusts, whether there's charity work that you wish to fund through the exit of your transition, private equities, ESOPs, employee stock ownership programs, many different ways of exiting a business, which is applicable these days to dentistry. So that is a little bit about myself. As I said, I've been doing this for 26 years. I've seen a handful of these transactions, more like a few thousand of them. So I've seen it all. I've been there. I've done that. There's not much that has occurred that somebody has come up with a new idea that I haven't seen before. I know what works and what doesn't work and how to protect dentists from finding themselves in a situation where they either get into a practice, they're unsuccessful, or they exit a practice, attempt to exit a practice. And unfortunately, we've seen many doctors that have destroyed the value of what is typically their single largest assets. So in order to understand practice transitions evaluations, we need to understand the marketplace. What is happening in today's marketplace? Let's look at both sides of the equation. The retiring doctor, which is typically the doctor that is selling the transaction. This is their practice in a transition. This is a graph that shows the graduation rates from dental school from the early 60s up until the recent 2013, 14 years of graduation. What I want you to notice here was the late 1970s, early 1980s was the largest graduation rates for dentists that we have seen historically. And how does this apply to practice transitions? Well, that was now about 40 years ago, almost exactly 40 years ago that we hit the peak in graduation rates. Those doctors are in their mid-60s and approaching retirement. So no different than what we're seeing just as a generation as a whole in the United States. We have a huge bubble of doctors that are practicing in their mid to late 60s that are going to be looking for exits here. A lot of young doctors for many years were waiting for this bubble of doctors who were going to retire and figured they would have their pick of the litter. The best of, there'll be so many practices available that they'll be able to pick and choose what is the right fit for them. That didn't necessarily occur. And what we saw was the Great Recession extended people's retirements. It made doctors more risk adverse and want to pad their retirement. And a lot of doctors lost a lot of money in retirement. So that has been put off. We have not seen those gluts of practices come on the market as of yet. What does it look from the buyer side? The millennials we found to be a very different generation. Career is very important to the millennial generation. However, family is important as well. We're seeing many doctors focus on getting out of dental school, getting a job, establishing themselves before they look at developing a family. And once they are established, they're making money, they begin to develop a family. A lot of doctors, a lot of this generation are looking for more flexibility in their work-life balance. And the number one issue influencing young dentists graduating is the explosion of student debt. Most doctors I talk to, general dentists, have anywhere from $250,000 to $450,000 in student debt. As a general dentist specialist, it's not unusual to see $600,000 or $800,000 in student debt. What you see here is a graph that was published in the Wall Street Journal that was concerning to me, and it showed the decline in entrepreneurial spirit amongst the population in the US, from a high of 10% of households that are headed by somebody under the age of 30 that have a stake in their own private business, down to 3.6% after the Great Recession. Is the entrepreneurial spirit in the United States dead? No, I don't see that to be the case. It has been curbed a bit. And we also, what studies have found is it has been delayed. So whereas we saw many people starting their own private businesses under the age of 30, that has been delayed into the early to mid 30s. We're seeing a larger number of entrepreneurs start their own business, and no different in dentistry, dentists acquiring their own private practice. So what did all of this mean to recent times as it relates to our profession as a whole in dentistry? It gave the perfect storm for DSOs, dental service organizations, also known as corporate dentistry, to enter into this profession. Sellers were looking to retire, but financially couldn't afford to do so, or they weren't comfortable doing so due to the Great Recession and those becoming more risk adverse. Buyers were coming out of dental school with tremendous student debt. Again, the Great Recession had caused a lot of dentists to become risk adverse and were scared to jump into their own practice with their student debt. Patients also began to be less tied to a specific dentist. The relationship between patient and dentist wasn't as strong after the Great Recession as it was before, and the relationship became with the insurance companies due to financial reasons. And what drove private equity and money into dentistry in order to buy practices, what's known as chasing yield. After the Great Recession, the Federal Reserve, no different than what we're seeing right now, dropped rates to the lowest levels we've ever seen. There was a mass of investment money looking for a place to land to increase the yield or return on investment that they needed in order to fund pension programs, private family businesses. All these investment professionals were looking for a way to get a greater return on investment, and they found dentistry as a spot to land. The last piece of the equation were the regulators. And in almost every state across this country, there are rules, laws that prevent non-dentists from owning dental practices. DSOs in corporate dentistry approached this situation by creating a belief that they were providing dentistry to underserved markets and those that dentists were not providing dentistry to. And the regulators have looked the other way. in a DSO is a creation of private equity in a way for non-dentists to be able to own dental practices. Is this the future of dentistry? We'll have to see. Look what happened to pharmacy. Every small town in the United States used to have a pharmacist on the corner. Veterinary practices, hardware stores. In a very similar type model to dentistry is optometry. It's already happened. Here is Smile Club in the back of CVS Pharmacy. You can go pick up your sunscreen, your toilet paper and paper towels, and go behind that aisle and get your orthodontics done. Aspen Dental is opening up in Walgreens. We're seeing Walmart open up healthcare and dental practices throughout the country. So what should you do to prepare yourself for a purchase of sale? It's important to determine your personal, your professional, and your financial objectives. What you'll find is that all of those are counter to one another. So your personal objective of spending as much time with your family and traveling is going to be counter possibly to the financial objective as making as much money as you can in order to retire one day. Use confident help throughout your career. One thing that I love about what I do is I get to work with dentists who retire successfully. And almost every single one of them works with an accountant, an attorney, an advisor that specializes in dentistry in plan. The earlier you start, the more options that are available to you. It's important to see the sale through the eyes of the other. In order to have a successful transition, both people need to be committed to a win-win. Remember, goodwill is everything on the buy side and the seller side. When a buyer's buying a practice, they're buying all the goodwill. So as you're going through the negotiations process, it's important to protect that. Same for the seller. When they're selling their practice, they want to see that buyer successful. So you want to make sure that the buyer is successful in the transition. Buyers have options. So when we're looking at valuing a practice and looking at transition strategies, it's important to understand what options are available and what buyers want. Most buyers want to make at least what they would make as an associate with potential for growth in the near future. That makes sense. Why would a buyer leave an associate position in order to buy a practice if they're going to make less? They want to pay off the acquisition debt in a reasonable period of time. That is typically 10 years. Finance 100% of the purchase price plus working capital. This is very important for every one of you to hear because there is a misnomer out there and a untruth that's being perpetuated. That is that with the student debt that most young doctors have, that there is not financing available. That is 100% false. Talk with any dental specialty lender and they will tell you there are plenty of opportunities to fund 100% of these purchases, plus working capital with a young doctor, $400,000, $500,000, $600,000 in student debt and not a penny to their name. Most buyers want to run their own practice. They want growth potential. Visibility is important to most doctors. Style, image, and technology is important. So let's look at the options that a young doctor has in order to practice in the private practice of dentistry. They can be an associate. There are definitely advantages to being an associate. There's no investment required. It's an opportunity to build hand speed and their skills, to learn from others' successes and failures. It's a holding pattern for the right opportunity and usually does not require binding commitment. There are definite disadvantages. You can't always do things your own way. Income is usually limited. It may be limited. You may be limited in the services that can be performed. Very little tax benefits. You will definitely be restricted by a covenant not to compete, and most likely will be restricted by a notice period. What does this mean? We're seeing a big issue in practice transitions where doctors or associates, oftentimes in corporate dentistry, where they're required to give a 90-day notice. If you're required to give a 90-day notice and you want to buy a practice in a very active market, most likely you will be last in line because most sellers won't sit around for 90 days to wait while you give notice in your position where there's another doctor that has a 30-day notice provision. So be very careful of that provision. Here's the biggest problem with being an associate for life. There's no ability to create wealth. This is a meme that I found out there that was very applicable to today's situation. It says, my boss arrived at work in a brand new Lamborghini. I said, wow, that's an amazing car. He replied, if you work hard, put in all your hours and strive for excellence, next year I'll get another one. The problem with being an associate is the tremendous wealth building ability of a dental practice accrues to private equity right now when you stay in a corporate run office. The challenge is that dentists can't practice dentistry into their late 60s, early 70s, late 70s. Your body will give out, especially at the pace that young doctors are providing dentistry these days. So while many dentists don't wish to have lavish lifestyles, at some point you are going to need to retire. And what we know through human behavior is that if you make $100,000 a year, you're going to spend $100,000 a year. If you make $400,000 a year, most people spend $400,000 a year. Wealth is created by owning your own business, taking the profits of that business and investing that over time. And we'll take a look and see how that looks. So there's another option for young doctors to get into private practice, and that's to start a practice. There are definite advantages to that. It can be built very near where you want to be. It can be designed exactly how you want it to be. You have the ability to create your own dental team. There are definite disadvantages. No or negative cash flow to start. Need to hire and train staff. There is a definite negative equity position, meaning that you owe more than the value of the practice for many years in the beginning. The leasehold improvements that you build out in a dental practice accrue to the landlord. They are not assets. They are known as what's known as a sunk cost. And they are more difficult to finance with greater working capital requirements. Here's the timeline for de novo, which is what's known as a startup. If you're building from ground up, it's typically anywhere from a year to a year and a half, sometimes 2-year process. If you are going to lease a space, you are typically looking at anywhere from 6 months to a year and a half to find the right space, negotiate all the permits, the contracts, the lease, and the actual build out. All that will take typically 6 to 9 months, sometimes 18 months. Here's the budget for a very bare bones, 1,800 square foot, 5 operatory, built out with only 2 equipped with a very moderate level of technology. We're typically seeing $450,000 to $500,000 to do a startup on a bare bones. What most doctors will find attractive is the purchase of a practice. There are definitely pros to the purchase of a practice. It's a shorter decision tree. There's an instant patient base, instant stream of income, an instant business. There's an experienced staff in place and trained, management and marketing support of the seller, proven market potential and site effectiveness, meaning that you know if you go into a specific location, what to expect based upon historical performance, the minimum you could expect going further versus a start from scratch, which is a jump in and let's hope this is successful. A proven market potential and site effectiveness and ongoing business momentum. But there are cons to acquiring a practice. The biggest one we found is there's a limited availability. There's not many good practices for sale in desirable areas at this point. Purchasing the seller's business and clinical reputation, for better or worse. Every practice owner, if you do nothing else, should Google your name after this presentation to determine what the dental community or the public thinks of a particular dental practice. Whether it's accurate or not doesn't matter, because buyers of your practice will be doing the same thing. Possible ill-fitted or outdated equipment. This is the biggest complaint we get from young doctors. that the equipment is old, dated. Depends what's important to you. I would argue that patient base are a heck of a lot more valuable than dental equipment, which is replaceable. And of what's of most value is the cash flow that the practice generates. The challenge of fitting into a pre-existing dental office family and entering in cold into a rapid day-to-day business and making sure that you have the ability to step into that role. Today's talk isn't about practice valuation, but I think it's important to understand practice valuation to see how it applies to what we're talking about in transition options. On our YouTube channel, ADS Transitions YouTube channel, there was a presentation about a month ago. Please feel free to go on and take a look at that presentation to learn about specifically practice valuation. But let's take a look at what drives value in a dental practice. First thing to understand is, what is fair market value? Fair market value is the cash or cash equivalent that an asset changes hands between a willing buyer and a willing seller, both knowledgeable of all relevant factors, neither under compulsion to act, with a non-synergistic relationship. You can see there's a lot of pieces to that equation, and it's important to understand that because fair market value is not always what is applicable when we're looking at transitions. So let's just take a quick peek at that definition. The cash or cash equivalent. That means it is not seller financed. It is not an equity earnout. There is not a holdback based upon the future success of a practice. When corporations buy a practice, very rarely are they paying 100% cash. And if they do, quite often there's penalties attached if certain goals aren't met. So that is very important, that an asset changes hands, not stock. When we talk about co-ownership, whether it's a corporation or a membership, it's not a share of a practice. It is all the assets of the practice. That a willing buyer and a willing seller, hopefully, of course, that's the case. Again, hopefully both are knowledgeable of all relevant factors, and hopefully both parties are not under compulsion to act that can sway the value. Non-synergistic means that there isn't a merger type acquisition or a special strategic acquisition, which could increase the value of the particular practice. So step number one is to collect information. Take a look at this list of what we need, and we're going to come back to this a little bit later in the talk. But typically we start with the past 3 years' tax returns, income expense reports for the current year, maybe historical income expenses reports, production broken down by procedure. This is a very important report. It tells us exactly what procedures you're doing in your office, so we can try and find that right match for the person to come in and take over with the clinical skills that you have in that practice. Production by provider, so we can see what associates are doing, what hygienists are doing versus the owner doctor. Number of active patients, it is a critical number, not necessarily to the value of the practice, but to the success of the transaction. And I will talk about that during our due diligence discussion. Hours each provider worked by month, patient visits of each provider by month, productions, adjustments, and receipts by month. What's the new patient flow? An employee census that shows each employee, their position, what their pay is, what their benefits are, how long they've been with the practice, practice philosophy, an equipment list, and many other things can go into this. But this is the primary place that we start when we're doing evaluation and putting together a prospectus. Let's talk about different valuation methods. The most common one used by dentists is the gross multiple method. It's a rule of thumb. It does not work. It is a terrible methodology for determining the value of the practice. Value is a result of multiplying current year's revenues by a percent. 55 to 90% is very common. We sell practices on the very low end of the percent range, up to 2 times collection. So it is a wildly inaccurate methodology. It's popular due to its simplicity, but not its reliability. Doesn't take into account cash flow, terms, location, demand, and many other important factors. A common methodology used by professionals in the field of dental practice transition is the market approach. It determines what a practice is worth based upon recent sales. So when you're working with somebody that is an evaluator, you want to make sure that they're a member of an organization that has multiple comparable dental practice transitions, ortho, perio, whatever your specialty is, to be able to apply those comparables to your particular practice. NACVA is an organization, National Association of Certified Valuation Analysts, American Dental Sales, ADS Transitions, American Society of Appraisers. In order to use a market approach, you have to be a member of one of these organizations. ADS Transitions, I suspect, has, if not, I know actually, because I'm a member of most of these organizations, has the largest and most accurate database of dental transitions that we're able to use to apply to a particular practice. Asset approach isn't used too often, but we do see that methodology used. It adds up all the different categories of assets in a practice, puts a value on, and the sum total is the value of the practice. Where I see this methodology used quite often is in what we call a hybrid practice, where it is a very tangible asset intensive practice with not a lot of goodwill. So a failed startup, or a startup where a doctor is leaving the state. Doctor invested $400,000 in technology and equipment, but the practice may be generating $300,000 in revenue. That is a perfect practice for an asset approach, because we can apply the value of the tangible assets plus put a value on the goodwill, and it makes sense for the buyer and the seller at that value. The primary methodology for valuing a practice is called capitalization of earnings. It is a relatively simple equation, but it is somewhat complex financial model that I'm going to try and make simple for all of you to understand. It determines a practice's worth by what it earns. The value of the asset, dental practice, is equal to its earnings, investment earnings. It's very important to understand that is the investment earnings, divided by capitalization rate. Capitalization rate is more easily understood as a required return on investment, or a rate of return on investment. So if most of you are familiar that you may have some financial background in order to understand that if you have $1,000, you have a choice of what to do with that $1,000 within an investment. You can put it into a bond, and these days you earn a return on investment of 1%. You can put it in the S&P 500 stock market and earn a 10% return on investment historically. That is your return on investment. If you put it into a closely held business, typically, and in a dental practice, which is closely held business, you should be getting an 18 to 30% return on investment. So in our equation here, in order to give the value, we need to determine what the earnings of the practice are, the investment earnings, and we need to determine the capitalization rate, also known as the rate of return on investment, ROI. I could spend an entire full-day seminar talking about how we determine the capitalization rate. For our purposes here today, understand that it's typically between 18 to 30%. The more desirable a practice, the lower risk a practice, the closer you are to an 18%. The less desirable or the more risky an investment, the higher you are to the 30%. Let's look at an example of valuing a practice based on this methodology. Again, I could spend an entire weekend on this methodology, an entire day on the capitalization rate. But for our example, we're just going to run through to see what drives a value in a dental practice. In our example here, we have a practice that's generating $1 million a year in collections. It has a normalized overhead. What does that mean? In order to determine the earnings, the piece of the equation, one of the pieces of the equation, we need to, step one, determine what a normal overhead for a practice is. That means you take your tax returns and you do what's called recasting the tax returns, or a normalization of tax record. We need to go through and pull out all the perks and benefits that an owner is running through for tax reasons. When you do that in a $1 million office, it's not unusual to have a practice with a 55% overhead. That will vary greatly depending on the practice as well as the part of the country. But in the Midwest, here in the Chicagoland area, it's very normal to have a mature practice with not a lot of marketing dollars going out the door with a 55% overhead. So out of $1 million a year in collections, $550,000 goes out the door in order to produce that dentistry. What's left over is the net income of the practice, $450,000. That is not the earnings that we're going to capitalize. Why is that? Because there's still one significant expense that hasn't been paid. That is a dentist to do the dentistry, because we're looking at this purely as an investment. So we need to pay a dentist to do the dentistry. What do you pay that dentist? A comparable compensation that they could get as being an associate somewhere. So in this example that has $1 million in collections, not all of that is produced by the dentist. 25% is produced by hygiene, leaving $750,000 in dentistry to be produced by the dentist. We're going to pay that dentist a typical fair associate compensation of 1/3 of collections, or 1/3 of the $750,000. We're going to pay them $250,000 to do the dentistry. What's left over are the investment earnings, or the profit of this business. This is what this practice owner makes just for owning the business. $1 million in collections, $550,000 goes to pay the overhead, $250,000 goes to pay the dentist to do the dentistry, $200,000 is what's left over as the entrepreneurial and the investment profit of this business. This is what dentists give up when they're an associate in an office. $200,000 a year, every year for their career. That is why I want to be very clear and attempt to be very clear when talking with young doctors on what they give up. I understand the benefits of being an associate, and there's nothing wrong with choosing that path, as long as you are knowing what you give up by choosing that path. Okay, let's take a step off my soapbox here and look at how we determine a value. Through an analysis, we determine that this particular practice has a capitalization rate or required rate of return of 25%. Take $200,000 of investment earnings a year divided by the 25%. This values the practice at $800,000. If this particular practice had a 20% capitalization rate, meaning it was highly desirable, great location, lots of technology, we divide the $200,000 by a 20%, it would value the practice at $1 million. Let's look at the transition options that are available. Transition is a change in ownership in today's particular talk. There are 5 types of transitions we're going to talk about: a retirement sale, an associate buy-in, extended sale, partnership, and merger. Let's look at a retirement sale first. This is the prototypical sale. Doctor works up until they're ready to retire, put it on the market, find a young doctor to come in, purchase the practice, and they go off into retirement. These are cash sales. Doesn't mean that a buyer has to have $1 million in cash to buy $1 million practice. That means they go out and get financing, typically for 100% of the purchase price, which absolutely is doable these days, and is paid to the seller at closing. They are buying assets, not stock or a membership in an LLC. There's typically very little transition time, if any. And these are the prototypical sales for practices generating revenues up to $1.5 million. In that $1.5 million to about $2.5 million, this can be a very common transaction as well, where we have husband and wife teams buying practices, or 2 doctors that are in a partnership. They may have gone to dental school together or known each other for a long time and are buying bigger practices in partnerships. The process is, once you find a practice to acquire, we often see offer to purchase as letters of intent. Sometimes they're applicable, sometimes they're not. The most important thing to know about LOIs, or an offer to purchase, is that it typically states that all the terms are non-binding, except for the seller gives an exclusivity period to the purchaser. Be very, very careful of what this says, especially when you're dealing with private equity or a corporate buyer. A lot of them say they have an exclusivity period for 90 to 120 days, which means you take your practice off the market for a long period of time, go through tremendous due diligence process with very little skin in the game from the purchaser. What I like to see in that exclusivity period is a bridge from the time that buyer and seller agree on basic terms until an asset purchase agreement can be entered into. My experience is that can be as short as a week to 2 weeks, extended up to 30 days if necessary. Beyond that, I really don't see the benefit of any exclusivity period, and it's very unfair, I think, to the seller and can create a lot of problems. So what is the document that actually binds the two parties together? It's called an asset purchase agreement, or an APA. It's going to talk about what's being purchased, the tangible assets, the intangible assets, how long the buyer is going to retain the records of the patients, and when the seller will have access, and how they get access to those records should they need to defend themselves in a malpractice case. It's going to talk about the tax allocation. Both parties will file a form called an 8594, which is how both parties will be taxed. It will deal with accounts receivable. Is AR being sold? Will the buyer collect the accounts receivable for the seller? What are the conditions of the closing of the transaction? How are you going to transfer goodwill? Letters to the patients, open house. Will the seller provide consulting services post-closing? Will they be in the office either providing dentistry or introducing patients? Staff and liabilities, how those will be dealt with. Representations and warranties. These are promises that both parties are making to each other. The seller is going to rep and warrant that all the information is accurate that was given to the buyer. Indemnification, which is a legal term which means both parties will protect each other from lawsuits post-closing. So the buyer will protect the seller from any lawsuit that occurs after closing. The seller is going to protect the buyer from any lawsuit that happened prior to closing. Rework provision. How are you going to deal with a situation where a crown has failed post-closing that that the seller did prior to closing? Every practice has the need for rework. There needs to be an agreement on how we deal with those issues. And of course, one of the most important parts of a practice sales contract is the covenant not to compete. Once the asset purchase agreement is negotiated, we go into due diligence phase. What is due diligence? Take a look at these reports: income tax returns, income expense reports. We went over all of these returns about 10 slides ago. This is the information that is needed for the valuation. This is the information that is given to a buyer for them to make a decision on whether they want to buy or sell a practice. Once they make that decision, we enter into an asset purchase agreement. It is incumbent upon that buyer to go in and make sure all the information that you as a seller gave to that buyer is accurate. If it is not, most likely the transaction will fall apart. That is why, remember I said number of active patients is a very important number. This is where we see the biggest issue. Seller tells buyer that there are 3,000 active patients. How'd they get that number? They went on Dentrix or whatever software, brought up how many active patients there were on the report, and that's what they gave the buyer. However, that is probably an accumulation of all the patients that have come into the practice over the past however many years you've been in practice. They are not active patients. Buyer goes in and counts active patients and finds 1,000 active patients. When in reality, your practice probably maintains the same value, whether it has 1,000 or 3,000 active patients. That deal probably won't close, and it'll probably fall apart a week or two before closing, because you represented you had 3,000. Buyer feels that they are getting a third the size of the practice than they made a decision to buy that practice on. So you really need to make sure all information that's given to the buyer is accurate, because they will check it and should check it during the due diligence phase. Let's talk about real estate. In every transaction, there's real estate involved. If there is a lease, then we have to go through the process of transferring that lease or getting the buyer a new lease. Most lenders require a buyer have a lease at least as long as the term of the loan, which is typically 10 years. So if you do not have that as a seller, we're going to need to get that for the buyer. If you own the real estate, there's two options. You can lease to that buyer, or you could sell to that buyer. If you lease to that buyer, then you're going to need to have a lease. as long as the term of the loan. Oftentimes we find buyers that want to lease with an option to purchase. There's many different ways to deal with that situations, from first right of refusal, first right of offer, an option to purchase the real estate. All of those have very different legal benefits to the buyer or the seller, and you need to understand those and be dealing with somebody that can navigate through that situation, because you don't want to find yourself in a situation where you can't sell your real estate either to the purchaser of your practice or to somebody else. And where do you get the money? So the buyers out there today have access to unprecedented amount of funds in order to buy these dental practices. Doesn't matter how much student debt they have, there is money out there for young doctors to buy practices. The most useful source we found are, without a doubt, dental specialty lenders throughout the country. There are many of them. Local banks rarely are good sources of funds, but in certain circumstances, they may be possibilities. The problem with a local bank is most often, in my experience, they tell you can do them. They can do those deals, but you find out a week or two before that they can't, and you're scrambling to get the funds. So if you go with a local bank, I would advise, and in my transactions, insist that the buyer have a backup from a national lender, a national specialty dental lender. Seller financing is not a good option for either party. From a seller's perspective, it is a high risk, in my opinion, scenario. There is the possibility that you won't get paid on the seller note. From a buyer's perspective, that is, I think, a terrible source of funds. When you buy a practice, goodwill is everything. And the best way to ruin goodwill is to borrow money from the person that you're buying the goodwill from. It is a bad scenario for both parties. Let's talk about what a delayed sale looks like, commonly thought of as an associate buy-in. A delayed sale means that you have a purchaser in hand prior to sale. This is, young doctor, come join my practice and I will sell to you at some point in the future. You can be my associate and then one day I'll sell it to you. It is a cash sale, meaning it's typically financed 100% from a dental lender. It is an asset sale. They are not buying stock, they are buying assets in your practice. And it is rarely successful. With proper planning, it can be successful. Why is it rarely successful? It is rarely successful because two things are typically not agreed upon. At what point the sale is going to occur and at what value. So in order to have success, when you say, young doctor, come join my practice, you need to have the ability to say to that doctor, and I will sell you this practice in 4 years. In my experience, anything beyond 4 years is not likely that it's going to happen. It's just too far in the future. So whether it's 2 years, 3 years, 4 years, you need to be at a point that you can identify in the future a date certain that it will happen. And, young doctor, when I sell you that practice, I want to be fair to you in that value. Because the typical thing that happens is that a doctor joins the practice, it's doing $800,000 in revenue. In 4 years, it's now doing $1.5 million in revenue. Buyer thinks they're buying based upon $800,000 in revenue. Seller thinks they're selling based upon the $1.5 million in revenue. That deal never happens. It's too wide of a gap. Associate, I understand their position. They feel that they're paying for the growth that they helped create. As a seller, I understand the position that that growth was created, whether that young associate was there or somebody else. And the fact of the matter is, if you terminate that associate and you have an associate contract in place, you can go to the market and get the value based on the 1.5 million. So in order to have this scenario work well, we have an associate enter into agreement where they have the ability to buy the practice at a date certain in future. The value is determined based upon a formula. What I find works well is you value at the date the associate enters the practice. The value is created again at the time of the transaction 4 years later. The increase in value and goodwill is split equally between both parties. I think that works well. It encourages the doctor to go out and grow the practice without being penalized for it. Let's look at an extended sale. An extended sale means that the transaction occurs just like in a retirement sale, but the seller stays on post-closing. There's some very important factors here. One, it's a cash sale, no different than a retirement sale. It's an asset sale. But the two most important factors is that the seller needs to understand there is a huge emotional adjustment that occurs. You need to be able to step back from being the owner of the practice to being an employee of the practice and watch the changes that the young doctor inevitably will make and be okay with that young doctor making those changes. I'll give you an example of a fabulous transaction I did about 20 years ago. Fantastic practice where we were executing a retirement sale or extended sale. Young doctor, perfect fit, came in, purchased the practice. Seller was staying on as an associate. And at this time, spa dentistry was becoming a very popular concept. So the first thing the young doctor did was replace all of the dental chairs with massaging chairs and put paraffin wax in each operatories. And the selling doctor, although the quality of dentistry was fabulous, the personality of the young doctor was fantastic and did very well with the patients and the staff. The selling doctor was furious to watch the young doctor makes those changes. So that's the type of thing as a seller you have to be okay with. The other thing that's very important from both the buyer and the seller side is that the seller has to be financially secure. That means I, as an advisor, cannot create a transaction where you are guaranteed employment, where you sell your practice to a buyer and you are guaranteed a position there for a period of time making a certain income. It's not going to happen. No buyer will enter into that situation. No advisor or attorney for that buyer will allow that to occur. So you have to be prepared for the seller, as the seller, to be able to be terminated a week after closing. From a buyer's perspective, you have to be very careful for running into a situation where a seller says, I will sell you my practice, but I need to work for another 3 to 5 years in order to retire. What that means is I'm going to sell you my practice for peak value, but I need to keep the patient base. And you and I are going to be fighting over patients in our schedule so I can continue to earn enough money to fund my retirement. So those are the big pitfalls you have to be very wary of. Let's talk about co-ownership. Co-ownership means some sort of partnership. I could spend not a day, not a weekend, but a week talking about this. The thing that's very important to understand is they are very complex. There are 3 documents that need to be negotiated at the same time: a buying agreement, an operating agreement, and a buy-sell agreement. The buying agreement is how are we getting into a partnership agreement, similar to an asset purchase agreement, but you're buying not assets, you're buying a undivided share in a whole. The operating agreement is the document that talks about how you're going to operate the partnership, typically 2 large issues that need to be talked about: income distribution, or how are we going to divide the profits, and control, who has control or decision-making authority in the partnership. And the third document, which I typically start with because it's often the most difficult to negotiate, is the buy-sell agreement. That means when one party exits the partnership or we bring in a third party, how are we going to deal with that? One thing you have to be careful of and understand is there are many benefits of having a partnership. Profit is not one of them. When you bring in a partner, you are arguably giving away the first half of the value of the practice. Why do I say that? Let's look at our valuation example. Here's a practice we looked at before: $1 million in revenue, 55% overhead, $450,000 in net income. Each doctor earns, or in this case, if you own the whole practice, you earn $250,000 for being a dentist, and there's $200,000 in profit left over. Practice is valued at 4 times that profit, or $800,000. So if you have somebody buy half your practice, they're going to pay you $400,000 for half the practice, which entitles that partner to half of the $200,000, or $100,000 a year. So you are giving the doctor half of the profit for 4 years, which they're giving back to you for the buy-in. So I would argue if you had an associate for 4 years, you would have the same amount of money, but own 100% of the practice. If you have a partner buy-in, you are giving the doctor $400,000 over 4 years, which they're giving back to you. So don't give away the first half of the practice unless that doctor is required to buy the second half of the practice when you are ready to exit. What many doctors don't understand is there is no market for half of a practice. So don't be in a situation where you gave away the first half of the practice and you can't sell the second half of the practice, or even worse, young doctor decides they're going to move to Arizona because they like the weather, and you have to go out and get a loan to buy Dr. One out, the junior doctor out when you're ready to retire. Let's talk about mergers. Mergers are phenomenal opportunities to grow a practice. Merger is not truly merging two practices together, as most doctors call it. That means you are taking one patient base and adding it into a second location. For a seller, it allows a pre-retirement sale. You know who your buyer is. It allows the continuation, especially for smaller practices. For the buyer, it is the best deal in dentistry. It's an opportunity to expand your patient base, increase your profitability by lowering your overhead, provides for passive income. It can double the value of the practice overnight, even taking into account the debt to acquire the practice. And if you're looking to add an associate into your office but don't have enough patients to go around, it is a great opportunity to add patient base, bring an associate into your office, increase the revenue, increase the net income, and decrease your time commitment to the clinical practice of dentistry. All right, the 800-pound gorilla in the room, corporate buyers. What do corporate buyers want? They typically want practices with at least $1 million in collections, at least 5 operatories with the ability to grow beyond that. They typically purchase 100% of the assets of the practice. They typically only pay 80% of that, often 70% of it at closing, with a 20 to 30% holdback, requiring the seller to stay on as their associate. And you only receive that 20 to 30% holdback if the practice, if you are still there and the practice maintains its revenue. Very common what we're seeing out there, other than what's typically called a corporate buyer, that is the private equity roll-up. What they are looking to do is typically somebody get in, buy multiple practices in one location, build up a group of practice that's generating $300,000, $400,000, $500,000 or $5 million in revenue, $50 million in revenue, and then selling it to the next private equity fund. A third is typically their payout, meaning that you get a third in cash, a third in a seller note, and a third in equity in the fund. Again, $1 million in revenue. They typically require the seller stay on as an associate. It's part of a roll-up and sold with upside potential. How are they valuing practices? They're typically valuing practices as a multiple of Ebitda. What is Ebitda? Ebitda, in our previous example, is a calculation of profitability. It is a what's known as a leveraged buyout calculation. So LBO means a leveraged buyout. Let's look at how corporations, private equities value practices. Here's an example of $1 million in revenue. Normalized overhead, we looked at this before, 55%. Net income to the owning doctor is $450,000. All of that is not net income. Net income has to be reduced by what you pay a dentist to do the dentistry. What's left over is profit, $200,000. This profit calculation is Ebitda. Ebitda stands for earnings before interest, taxes, depreciation, and amortization. It is a financial term. And it is, most private equities and corporate buyers are paying 3 to 6 times Ebitda. What you need to understand as an owner of a practice is that you're participating in what's known as a leveraged buyout if you sell to a corporate or a private equity fund. Leverage buyout means that they're using your profit, your Ebitda, to pay you for your practice. So in this example, if you sell your practice and you're required to stay on for 3 years as an associate, and you're paid 3 times Ebitda, you're paying for your own practice. If you kept your practice for 3 years, you would generate $1 million in collections, $550,000 goes to overhead, and you keep $450,000 for 3 years. If you sell to a corporate buyer, $1 million in collections for the next 3 years, 550 goes to overhead, 450 is the net income. You get 250,000 as a fairly paid associate. The corporate practice gets $200,000 a year for 3 years, or $600,000 in profit. They paid you $600,000 for the practice. So you're basically paying for your own practice. Even if it's 6 times Ebitda, let's say they pay $1.2 million for your practice, you are paying for half of it by staying on for 3 years. Why not just keep your practice for 3 years, keep all of the profit, $450,000, 250 plus your 200 in income, and then sell at that point. So there's nothing wrong with going down the path of selling to corporate, as long as you understand what's going on from a valuation perspective. From a buyer's perspective, it's important to understand compounding of interest. Very smart person here. Albert Einstein was quoted as saying, compounding of interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. A colleague of mine, Earl Douglas, wrote an incredible article that every young doctor should read. It's on our website, adstransitions.com. You could Google also the $14 million decision, and it tracks 2 doctors. One that graduates dental school and decides to become an associate for life, one that works for a few years and buys their own practice. Each doctor producing the same amount of dentistry, $855,000 a year over a 33-year career. The doctor that owns their own practice accumulates $10 million in additional net worth, in accumulated profit, $4 million in additional income, and it assumes no value for the practice sale at the end of a 33-year career, assuming a 3% return on investment. Not 10% that the S&P typically returns, but a 3% return on investment. $14 million in net worth difference. There's no funny money here. It is an accurate portrayal of the difference between owning a practice versus being an associate. So how do you obtain financial independence? Building wealth is created by owning assets, regular, continuous, systematic investing over a long period of time. Here's another very smart individual, Warren Buffett. He was quoted as saying, "My wealth has come from a combination of living in America, some lucky genes, and compounding of interest." As a young doctor, if you understand this concept, it will help you tremendously throughout your career. Let's take a quick look at the top 10 deal killers. Accounts receivable. If you have old AR on the books, clean them up, get them off. Post-employment, the seller sticking around too long can be a huge detriment in the acquisition. Selling too late. Larger practices have higher values. Smaller practices are becoming more difficult to sell, so the traditional path of pulling back and running a practice down can be problematic in the sale of a practice. Space sharing agreement and associate agreements, you have to be very aware of what are in these documents. They can kill a practice. An associate agreement without a good non-compete could destroy the value of the practice. Having a first right of refusal in a space sharing agreement or associate agreement can destroy the value of a practice. Outside influencers, know who they are and be aware of what they bring to the table. So on a buy or sell side, that could be the spouse, friend, cousin, whoever it may be. We're seeing chat rooms Facebook groups influencing how parties negotiate in these deals. It can be very frustrating. Deal fatigue. Deals are taking longer and longer. The longer a deal goes on, the more likely it will fall apart. So be very, very aware of your advisors and what they are adding to deal fatigue. Landlords and leases, they are part of every transaction, but they can be very, very problematic. So know who your landlord is and how to deal with the roadblocks that they can put in front of you. Accountants that don't work in dentistry can be hugely problematic. Attorneys that don't work in dentistry can be hugely problematic. There's two types of attorneys we typically see out there. One are transactional attorneys. Hopefully you're working with one that specializes in dentistry. One are litigious attorneys that litigate all day long. Litigation attorneys can destroy deals. In death or disability, I often say, as a dentist, one of the most selfish things that you can do is leave your family to deal with the disposition of your practice when you are gone. There's absolutely no reason that you can't be prepared to have your family deal with the sale of your practice in a death or disability situation. Every one of our practice transition consultants at ADS Transitions can help you be prepared in order to get full value if you were hit by the bus the next day. So reach out, contact one of our advisors, and they will do that for you. Most of them, I certainly do, at no cost. Thank you very much. Please feel free to reach out to our website, adstransitions.com, or when you registered for the seminar, you got an email address for our executive director. Send any questions and answers to that email address, and I'd be happy to answer those. Also, please reach out to adstransitions.com to look for the tremendous amount of information we have on that website on practice valuation, transitions, associates. Anything you would want to know about practice valuations and transitions, you'll find as a resource on our website in order to educate the dental population. Thank you again, and I hope you enjoyed today's presentation.